All right, let's get right into it. This week in the world of money was something else. We saw a Wall Street titan go shopping, a payment network laying down brand new tracks, and a fintech incumbent, well, they took a massive tumble. It's a story of offense, defense, and a complete and total faceplant. I mean, seriously, can you even remember that? Because if there was any doubt, this week proved those days are long, long gone. The entire landscape is shifting right under our feet, and the moves being made right now are going to set the stage for the next decade of finance. So let's meet the three main characters in this week's drama. First, you've got Morgan Stanley, the Wall Street giant making a really bold, offensive play. Then there's Mastercard, the global payments network, who's busy building the future. And finally, Fiserv, the established incumbent who just gave us all a masterclass in what happens when things go very, very wrong.
Okay, so let's kick things off with Morgan Stanley. See, they aren't just sitting around waiting for the future to happen. Nope, they're going out and literally buying a piece of it. And their target? A really fascinating corner of the market.
Morgan Stanley just announced their plan to acquire a company called EquityZen. Now, what makes EquityZen so special is that they have built this amazing marketplace for shares in those huge unicorn companies. You know, the big names like Stripe and SpaceX that you hear about for years before they ever go public. And here is the absolute key to this whole deal. By owning EquityZen, Morgan Stanley can offer its massive base of wealthy clients a golden ticket. It's the ability to invest in the next Stripe or the next SpaceX before the IPO. It's all about getting in on the ground floor while it's still, well, private. Here's probably the best way to think about it. You know how a platform like StockX lets you buy and sell super rare sneakers? Well, EquityZen is basically the StockX for unicorns. Instead of flipping rare Nikes, their users are trading shares of the hottest startups. It's a huge bet on owning the private market before it ever becomes public. All right, so while Morgan Stanley is buying up access, let's shift gears to our second player, Mastercard. They're taking a different approach. They're busy building the infrastructure, the actual plumbing for a whole new era of digital money. And they are not just dipping a toe in here. They are making some serious, calculated moves. They're reportedly in talks to buy a company called ZeroHash, which already powers crypto services for huge fintech names. At the same time, they're partnering up on stablecoin payments. That's basically digital currencies tied to something stable, like the US dollar. This is a coordinated push for sure. And this is the most important thing to get about Mastercard's strategy. They aren't chasing the hype of some random coin. Nope. They are building the fundamental rails, the pipes and wires that digital currencies and stablecoins are going to run on. They're betting that the next wave of payments is gonna run on the blockchain. You know, this move feels so Mastercard. Over the past 5 years, they've just been scooping up companies left and right in AI, fraud detection, and open banking. Now they're adding crypto infrastructure to their shopping cart. They are basically the DJ Khaled of money movement, always adding another hit to the portfolio. And that brings us to our third and final story, which you'll see is a pretty stark contrast. Because while some companies are out there building and buying the future, others are just struggling to deal with the present. Let's talk about Fiserv. Oof, yeah, just look at that number. Shares of the payment processor Fiserv completely cratered, down 44% after its latest earnings report. That's not just a bad day, my friends. That is a 5-alarm fire that has Wall Street completely spooked. So what did management say happened? Well, they pointed to a couple of vague things. Client integration challenges, and macro softness. You know, it's the kind of standard corporate jargon you trot out when things are not going well. But come on, let's be real. That is just Wall Street code for things are broken and we're not sure how to fix them. It suggests their big merger from a few years ago still isn't working right, and that leaner, meaner competitors are eating their lunch. I mean, the stock chart looks less like a stock chart and more like a black diamond ski slope. The whole situation has a certain WeWork energy to it, if you know what I mean. It's just a brutal reminder that being a huge, established player guarantees you nothing, especially if you can't execute. So, you've got these three very different stories, all from a single week in finance. But when you put them all together, they paint this fascinating picture of a great reshuffling that's happening in the industry right now. So, let's just put it all together. On one hand, you have Morgan Stanley betting on owning access to the next big thing before anyone else. On the other, you've got Mastercard, betting that the future of payments itself will run on the blockchain rails that they're building right now. And then you have Fiserv,
serving as this huge cautionary tale. Being the legacy giant is no protection if you can't keep up. 3 companies, 3 totally different bets on where money is going next.
And all of this leaves us with a big question, right? In this massive industry shakeup, who ultimately comes out on top? Is it the bank that's buying the future, the network that's building it from the ground up, or will the giants trying to play catch-up somehow find a way to turn things around? It's definitely something to think about.